Good morning, Doc. How are you?
Yes, I'm good, Lou. How are you? Did you enjoy Easter?
I look forward to the bunny bringing no further interest rate increases, inflation to stay low, and unemployment to stay even lower. How about that?
Well, I guess it's good to have aspirations, and I'm not sure about the interest rates, but we've got to count our blessings as we've got them, and certainly that was an Easter surprise that we didn't have another increase in interest rates, and that's good news for housing markets, I believe, because housing markets have been up and running really this year so far, and without the spectre of another interest rate increase, I think that will only add to confidence, really. But as you say, we need to keep that unemployment rate low, economy strong, and everything to keep moving along. I think there's a lot of value in our housing markets at the moment, and I think that's one of the key drivers of higher prices, and we're certainly seeing higher prices coming through.
Well, the interesting part is I have been watching the market in Sydney because I was looking at something. It's moving quite quickly. I'm surprised at how quick the market is moving. Yeah.
Yeah, well, Sydney led the market down, of course, last year, and it led the market up the year before. Very strong results in Sydney. We know it was a good old-fashioned boom, really, for a couple of years and through that COVID period. And it was just catch-up energy, really, because people had to sit on their hands during lockdown. As soon as lockdown conditions eased, people were out and about buying and selling where they hadn't been able to, and that created that surge in prices. But all good things come to an end, and high prices meant that a lot of buyers were pushed out of the market a year ago in Sydney, and that's just the natural way things work, Lou. You know, prices move ahead of capacity, and then the market has a pause. It did last year in Sydney, and of course it was the first of the markets to ease, from that sort of post-COVID surge. And, now it's the market back up and running again. And it certainly surprised a lot of the doomsayers, the naysayers that were predicting very significant declines in prices. In fact, it was only really about the winter market last year where we saw, a real shakeout in the market. And that's what we expect in winter anyway. And coming from a very strong period, and interest rates increasing, which obviously impacted confidence because they hadn't increased for 10 years. It was quite a shallow decline, really. And markets started to improve from September last year. Now, even though prices were still falling, they weren't falling at the same rate. So that was gradually improving. The trend improved till finally in February, we got a positive result in Sydney and followed up in March. So we've had two consecutive quarters of higher prices in Sydney. And now we've seen Melbourne join the action. First time in a year, Melbourne's had higher prices recorded over March, and all the major capitals actually recorded higher prices over the March quarter. So, but, having said that, yes, it's obviously good news for home sellers. But I think the value aspect is growing, because even though we've seen Sydney house prices are up over 2% so far this year, Lou, which is a good result over 3 months. But they're still 7% lower than where they were a year ago. So I guess if you're a savvy buyer, you're thinking, well, prices are rising, but they're still lower than where they were a year ago. So I can pick myself up something that's really good value here, because I'm under the mark compared to a year ago, and yet I know that prices are rising again. So these opportunities aren't going to last forever, particularly given we've had this pause in interest rates.
Yeah, it really is a time, if you're able to borrow the money, it really is time to jump in.
Yeah, well, that's right. And, it's like I said, it's that sort of, fear of missing out value perception that is very strong in our marketplaces. And, that's just sort of, speaking about the mindset. But the one thing you can't avoid, Lou, is, when you have too much demand and not enough supply. And this is a clear driver of the Sydney market. We've just got an abundance of demand coming through. not just that, revival in the cycle, the fear of missing out energy that, prices are lower than a year ago, good time to buy. But it's also the flood of migrants that we're getting into Sydney and Melbourne and Brisbane.
Yes, all of them.
With borders opened up again. And, we just haven't been building enough homes over the last 5 or 6 years. And it's finally caught up with us in spades because, we now have this from 0 to 200,000 plus, people coming into the country. And they've got to find somewhere to live. We're not going to say, yeah, come and live in Australia. Great, but we can't find somewhere for you to live. You're going to have to live in a box or something, no way. So they're busily hunting for accommodation. And it's not just those permanent visa entrants, Lou. It's now we've got the students up and running again, where China's now moved away from its lockdown policies. It's telling its students to get out there and, get yourself a qualification. Our universities and higher education, facilities are all saying, yeah, hey, we want this face-to-face. We don't want the online stuff. We're really more into the face-to-face learning. So, it never rains, it pours. So we're now getting, as well as all the permanents, we're getting, a surge in students as well. And that means particularly that we're going to see even more pressure on our rental markets, Lou, which are just downright crazy at the moment. There's just it's an unrelenting surge in higher rents. Particularly unit rents are going through the roof. I've got the latest data, Lou. I have, and I track daily prices and rents, but we've now got Sydney's median unit rental at $700 a week. That's for an asking rent, which is exactly the same as a house, mate. That's exactly the same as a house. So unit rents have now caught Sydney rents and $700. And that's like a 40% increase in a year. But of course, a year ago, there was plenty of stock around for units in Sydney and Melbourne. So they're coming from a very low base. But nonetheless, we shouldn't be surprised because obviously tenants are being squeezed out of the market and they've got to look for more affordable accommodation. And that typically means units. But now, units are the same rent as houses. So are they as less affordable? Well, or more affordable? Well, no, they're not. They're the same. But this is, and we're seeing the same gap close between unit rents and house rents in every capital city, Lou. So this is a never-ending issue. And, of course, it's only going to work its way into inflation and higher wage demands because people need to find the money for the rent. Hopefully not, but probably more interest rate increases if the Reserve Bank sticks to its policies. But we don't know what the Reserve Bank's going to do because, heaven forbid, they're a bit of a flip-flop sort of organisation, aren't they?
Bit all over the place, really, aren't they?
Yeah, so we've got plenty to talk about, Lou. In fact, today, as usual, of course, we've got plenty to talk about. But today I've actually got together some the latest data on building costs. And I think that's a very interesting topic because we're still getting, unfortunately, on a daily basis almost, headlines regarding building companies that are under pressure. Some have closed, sadly. And this, of course, is now the result, which is, I would suggest, accelerating of those high building costs that have come out of that home builder policy of a couple of years ago. And I think, building companies can absorb these things over a period of time. But at the end of the day, X doesn't go into Y, then you can't trade. And that's the way it is. So maybe we could start today by looking at those building costs.
All right. Well, should we start with maybe putting all your credentials and all your qualifications?
Well, we could do that. I think
where your knowledge comes from.
Well, I think it's important if you're a talking head in any field, Lou, that at least you have some formal qualifications, which I do. So I did the hard yards in terms of study, and of course, all my qualifications are in housing market economics. as well as that, I have higher degree qualifications in research. So I think it's important also that you understand how to do formal research. And I'm also a member of the Royal Institute of Chartered Surveyors. So I guess I have a professional body behind me as well. So I think that's important to have those formal qualifications if you do situate yourself as a talking head. And I've also had a lengthy career as a property economist. My last formal role was as chief economist for the Domain Group, but I've been acting as an independent commentator and analyst and data provider since I left Domain, which is some time ago now. So it's all good. And I think, yes, thank you very much for giving me the opportunity to spout my credentials. And I do think it's important, though, whoever you listen to, at least ask them if they've got any qualifications or experience in this work before you start making a decision based on what they're pronouncing. And we get a lot of interesting commentary in the housing market, don't we, Lou, from various sources? And it's usually negative because it's an exciting headline. But I think the key here is do not make a decision based on something, especially a big decision around property, unless at least you have some sort of a credible, sort of analytical process to rely on.
I suppose my first investment was 1975, so I've lived through many booms, busts, drops around and all the rest of it. I know that on average with my portfolio that in every 8 years, now it's not precise, every 8 years it does double, So, it might take 13 one year and then the next year it'll be 3. But on average it sort of gets there. But it's quite a
I think most savvy Australians realise the roadway to wealth in Australia is through property, and you don't have to be a spruiker to say that because the evidence is clear. Historical evidence is clear, and, we're geared towards property investment in this country because we have so many locally generated tax advantages that, that we've created because of our connection to property, and a very strong private rental market. Discounts for capital gains tax. We don't pay capital gains tax on the family home, negative gearing, tax depreciation. All these things add up to the capacity, to generate wealth through property. And it's been a real truism. We say in this country, bricks and mortar, safe as houses, and we all understand what that means. And the point is you don't have to be a spruiker, really, to sort of tap into that, because the reality is exactly what's happened over, decades, really, through all the cycles, as you said, through all the ups and downs which come along, of course. But now we're in a particularly, position where we've just underbuilt for so long that, the outlook, normally we catch up with our building levels through the cycles, but this time we haven't. And it's becoming even tougher now to match supply with demand. And that can only mean higher rents and higher prices. And I think it's going to get tougher and tougher to actually buy a house going forward, Lou. And these are changes that are occurring that are sort of systemic. They're nothing we can really change to make, property more available. And I think that's a big lesson for those, in looking to get into the market, particularly for the first time as an investor or an owner-occupier, that it's only going to get tougher going forward, let me tell you, not just because of, issues with the economy or interest rates. And we're very lucky in this country to have such a strong economy. In fact, it's, the strongest economy in the world per se on a number of measures. But it's not just about that. It's just about that we just don't build enough houses. And, you just can't offset that particular equation. So shall we get into our slides, Lou?
Yes, sir.
Well, there we are. That's my brand, My Housing Market. Of course, I act as an independent commentator for the housing market. We also provide data as well as commentary. And our data's been particularly well, I guess, received recently, as we have been the first to show that prices are rising again, not just the national market, but those capital city markets as well. So look out for the My Housing Market data as it comes through. And, usually comes through faster than anybody else. So first with the latest, Lou, I guess we could say. But we did mention that building costs are an issue in Australia, and this has all come about through the surge in building that we had 2 years ago. Home builder, of course, was a policy introduced by the previous federal government. It was designed to stimulate the building industry through that COVID period. which it did, and we can't criticise the policy because it was very effective, and we were still in a very uncertain period. We didn't know where our economy was heading. We were still in lockdown, so the government introduced Home Builder, which was a significant stimulus package for those looking to particularly build a new home, and that meant a new house. So it was probably, we could say, oversubscribed, very popular. But the problem, Lou, was that so much demand from Home Builder meant that we just didn't have the building materials or the labour to match all that demand. And, of course, we know what happens then when there's too much demand and not enough supply. Prices go up, and they didn't just go up. They went through the roof. So we've got the latest data here for quarterly house building costs. So this is ABS data, Lou. It's derived from the ABS. So what this does is it looks at the value of house building, and then it looks at the number of houses that are being built. So we just divide the value of house building by the number of houses being built in a period, and that gives us the average cost of that particular house. So it's not rocket science, but it's certainly a reliable data source. And the latest data that we have is February. That's the latest building approval data. But really no change that those house building costs, and these are houses we're talking about, remain significantly higher compared to the same period last year. And, of course, this has been a real driver of higher inflation, Lou, has been house building costs. They've made up a high proportion of the inflation rate. We're really looking to see house building costs ease, so to take some pressure off inflation and therefore some pressure off the prospect of higher interest rates. But we still remain significantly higher than where we were a year ago. So this is the index, which this just creates an index based on those average costs, so you can see the trend more clearly rather than the actual cost. It sets the 100 as a base back in 2018. But you can see that up until that Home Builder policy release in 2021, Lou, that building costs were pretty flat.
Yeah.
They really didn't move a lot, and that was a good thing for the industry because there was a lot of certainty in terms of how building costs were rising. So, of course, we know that most houses are built on a fixed term or a fixed price contract. So builders know that their prices are going to rise. Well, before Home Builder, that their prices would rise by, say, 2 or 3% a year. So, it's a very competitive industry, of course, home building. Margins are low. But it meant that, with some surety over, the movement in costs, that builders could make a profit. Now, of course, all that went out the window when you can see that quite remarkable surge in costs, as we discussed, through Home Builder. And really, the index has shown no sign of significant easing. So this is covering the sort of the period. These are quarters, but you can see that the latest February quarter is still well above where it was last February, Lou. So,
Yep.
Not a lot of relief there. And that's a real issue because, we're seeing it's not just the level of house building costs, it's that they're still increasing, on an annual basis. And, that's not good news for inflation. And it's certainly not good news for builders who have to, try to cover these higher costs and still make a profit. And this is the problem, that they can't make the profit. And now a number of them are having to close their doors because they can't match what their costs are with the price of, that they get for their new product. Although the rate of annual growth eased marginally, and it was down a little bit over the February quarter compared to the previous January quarter, those results are still at extraordinary levels and are certainly placing pressure on home building profitability, as we've discussed. And you can see there, that shows you the rate of change from year to year on an annual basis. You can see how flat it was up until that Home Builder policy. there really wasn't a lot of change happening. But then we got to the point where at its peak, it was nearly 25% increase in a year. How do you absorb that? 25% increase in building costs at its peak. Now, it has improved since then. We can see the trend is falling in terms of those average increases the annual increases in average house building costs. But it's still, significantly higher than we would like to have it comfortably. And, even though it's improving, it's taking a long time to improve. And, there's still a lot of stress in house building. And of course, one of the real issues is one of the real issues that we have, Lou, in this undersupplied, housing market is that this is just another disincentive to build. It just means it's even tougher to get the buildings that we need to house all this demand, because of high building costs. We're seeing building companies, unable to trade. And that means obviously, less capacity to build the houses that we need and the units that we need to house, or particularly all the migrants that are coming through. So as I said, that even though we're starting to see an improvement in the rate of growth, it's still crazy stuff. We need to have rate of growth 2 or 3%, not 16% in a year. So even a year ago, we're still sort of skyrocketing compared to a year ago. So a little bit of an improvement, but certainly not enough to take pressure off building companies and also to sort of re-energise supply, which isn't going to happen anyway, regardless of building. But nonetheless, it certainly makes it very tough for builders and for those that wanting to build a new house with these prices rising. And builders would be very wary about signing a fixed price contract for a house under these circumstances. So we actually broke it down into the capitals, which I think is interesting, Lou. We can see which capitals are performing the best in terms of house building costs. No surprise that high-priced Sydney market is the clear leader for house building costs over the February quarter, followed by Melbourne. High-priced Darwin always has very high building costs. It's in third place there, and Brisbane and Adelaide, which of course is the most affordable, next to Perth, one of the most affordable housing markets. Adelaide has the lowest house building costs, and you can see them all there. Lou, we have Sydney over $500,000 per. That's the average building cost for a house over the February quarter. In Sydney was $500,000, ahead of Melbourne $478,000, and Adelaide the underperformer there at $364,000 value there in terms of its the cost to build a new house in Adelaide, and Darwin there in third place at over $400,000 average cost. So I think that's quite interesting. No surprise, I suppose, that Sydney is the most expensive place to build a house. But there's not a lot of houses that are built in Sydney these days anyway, Lou. It's sort of about units. And as we've seen with our building approval data, even Sydney's starting to lose its mantle as the top performer for unit building. It's moved into third place behind Brisbane. Can you believe it? Sydney doesn't build as many units. So, again, even though that price is high, there's not a lot of activity happening in that Sydney house building market. But that's the actual price or cost to build a house in the capitals, with Sydney at the top. And no surprise that, in fact, all capitals reported higher house building costs over February, with the exception of Sydney, where costs were actually marginally lower over the quarter. Even though they're high, they were, or the highest, they were just down a little bit over the quarter. And maybe that reflects the fact of, less activity happening in that Sydney house building market. But I think the really interesting data, Lou, is that the Brisbane has clearly recorded the highest growth in house building costs over the past 2 years. It's just gone through the roof, building costs in Brisbane. And you can see there that if we look, we can see Sydney just falling below the line over February. But prices, as we've seen with the national price, certainly not too bad over the year, but around about 15, 16% in the other capitals over the year. But when we look at the 2-year performance, Lou, we can see Brisbane house building costs have actually increased by nearly 45% over 2 years. Of course, we know that's about all that southern demand that came in, as well as
COVID.
sort of the energy, a lot of demand for housing in Brisbane. And that only exacerbated the demand that came from home builder, the policy. So it's sort of a perfect storm of, lots of migration out of southern states fleeing the lockdowns into Brisbane, as well as the home builder, the home builder policy, which created even more demand locally and created those shortages. But that's quite remarkable, that increase in building costs in Brisbane, 45%. So that's not so good news on house building costs, Lou. It just means just tougher and tougher to build a house. Not just if you're a buyer, but if you're an actual builder as well. You got to make those ends meet with costs versus prices.
Absolutely, and it's not only material costs; it's labour costs too.
Yeah.
Which is a reflection probably of some of this also.
Absolutely, yeah, but this does include labour costs, and
yes,
it's just the shortages that we have, and I'm not so sure. It was certainly. I would suggest that a lack of building trades is one of the keys to looking at our migration job profiles. That we're looking to get people with trade skills to come into Australia to alleviate the high cost of house building. But I'm not sure that, that even if that's the case, that we're looking for more tradespeople, whether it's going to make a difference in the short to medium term anyway. I think that'll take some time for any sort of adjustment. But, I'm not sure also that there's been any significant, sense that this is easing to the point where it doesn't become a problem. And it's not just a problem for inflation and higher rates, interest rates. It's a problem that it's just another factor which is keeping us from building, the houses that we need to build to match the demand, that's coming through. Yeah. So I thought that was interesting data today to look at, Lou, the first here, of course.
Absolutely.
With the data. We've also got those capital city breakdowns. If we look at the big picture in terms of the economy, I thought the one thing that was interesting this week, Lou, in terms of the international economy, is we've actually started to see oil rising again, the price of oil. Now, I don't know if you've noticed that the Bowser that prices went up over Easter. I'm not sure where that surprised.
Of course.
Over Easter, started heading towards $2 a litre again.
Yeah.
But, it is Easter, big surprise. But maybe there's also a little bit to do with higher international oil prices because they have increased. And the reasoning behind that is that the oil producers have decided to cut production. They've decided that, I guess they're going to play their games again, maybe. Cut production. Of course, that means with less oil around, it'll mean higher oil prices. Now, we can see the latest data on the price of oil. It has bounced back. It's eased from its very strong highs of a year ago. In fact, it's, sort of half what it was a year ago. But nonetheless, it's starting just to pick up again on the back of that cut in production that was announced last week. So we have to keep a pretty clear eye on this one, Lou, because if we start
say a timely price reduction in production, a timely.
Well, yeah, and this is the point. Just look at where the price of oil was prior to COVID. We're double where it was prior to COVID. So we're still sort of a long way higher than where we were prior to, COVID. And so now we're rising again. And, it's not just the absolute cost of fuel, of oil. It's the rate of growth, and that's the point. If it starts increasing, then we'll start seeing, because of course it works its way into transport, logistics, all these types of downstream factors, and then people have to, counter it with higher costs, as transport costs increase. So we need to keep a real eye on that one. Still at $80, $80 US a barrel, but certainly has picked up after a period of flattish results there. Still well below where it was a year ago. But nonetheless, if they continue to cut production, Lou, it'll only mean that price of oil will go higher. It'll only mean higher petrol costs, and that'll work its way into inflation. And unfortunately, that will mean, all things being equal, that we may see some higher interest rates as well. So I think that's an important slide for our viewers to just ponder and to keep your eye on that price of oil, because it's a bit of a precursor to what happens, particularly with inflation and interest rates. So I hope you enjoyed your Easter, Lou. I'm sure you were very prudent and didn't eat too many Easter eggs.
Not too many chocolates.
But then again, maybe you did. But that's the way it goes. It is Easter after all. Yes. But we did have a break. It wasn't just a break for everybody enjoying that Easter super long weekend, but our auction markets also had a break, of course. As usual, they paused. There are only a handful of auctions that were conducted over the weekend, Lou. Not really worth reporting on. Sydney had about 80 auctions. Melbourne only had about 40 auctions, and there were basically none everywhere else. So it's not really an indication of the market. So we didn't put our results up for the weekend. But I think it's interesting when we do get to Easter, Lou, just to speculate on the outlook, because Easter typically signals the end of the first part of the autumn selling season. And we start typically beginning of February, markets ramp up, then we run all the way through to Easter. And then we sort of know, obviously, how the market's tracking, because that's, a period of 6 to 8 weeks typically. And we know that, it's been a very robust period for our auction markets. We'll look at those monthly results in a minute, but it has been a positive period for auction results. Auction clearance rates, particularly in Sydney and Melbourne, are well above where they were when they finished the year last year. We're consistently seeing clearance rates in the 70s. And once we get into the 70s, that does signal that sellers are starting to get the upper hand in the market, that there are more buyers than sellers. And, of course, we know that as well from the increase in prices, particularly in Melbourne and Sydney, which have been moving up into that 70% region through most of the early part of autumn. So it's been a big start to the year, Lou. And even though we've had higher interest rates in February and March, it hasn't held that market back at all. So I'm thinking that, with a pause, it'll only be a positive going forward. We know that demand is ahead of supply. I think on reflection, which we can use the Easter break as a period to look back, that it's been a very positive revival in our housing markets over the first 3 months of this year. And I think the prospects are pretty good for the second part of the autumn selling season, Lou, and that, of course, runs its way up until basically the Queen's birthday weekend, which in most states, well, I'm not sure these days, I think, so I suppose it's the King's birthday weekend now, will be in that first weekend of June. So that's basically the end of the autumn selling season, is that's marked by that holiday period in June, which, used to be consistent, but it's not now, but that's life. So interesting to see how we pan out. Nothing much is going to change. We'll get our first results coming through this weekend, Lou, the Easter bounce back. We'll see what happens there. And as we know, when we look at the breakdowns, that auction clearance rates are a very positive indicator of what generally happens in the housing market. These are Sydney house prices versus clearance rates. You can see how they track each other. Higher clearance rates, higher house prices. Similarly in Melbourne, higher clearance rates, higher house prices. This was the pre-Easter weekend results. You can see there that we had everybody over 70% except for Canberra. So that was a great pre-Easter result in terms of our housing market activity and from higher numbers of auctions as we usually see in that pre-Easter Super Saturday of auctions. And the monthly results, you can see where in Sydney we're basically back to where we were a year ago, and that's just showing that the latest April results. So 70% results there in Sydney this year so far. Same in Melbourne, they're back to where they were a year ago, which was strong market conditions. Brisbane a little bit up and down, but it did finish or it ended the first part of that autumn selling season with a strong plus 70% result. Adelaide as usual, again a bit up and down, but the strongest market there, always tracking around about 80%. And Canberra's been the underperformer, a little bit of a soft market in Canberra, but Canberra will tend to follow that Sydney market upwards with the momentum there. But there are some local factors in that Canberra market that's just making it a little bit more problematic in terms of development. And a number of those factors do relate to local property taxes, which we might talk about going forward, which I think might be impacting that Canberra housing market. But as I said, typically Canberra picks up as Sydney picks up, but we'll see how that pans out. So you can always get my auction clearance rate every Saturday night on my LinkedIn channel, Doc Andrew Wilson. Everybody's welcome to see the snapshot of a Saturday night for the capital cities, and Sunday morning we have the full national report on LinkedIn as well. So look out for that. And that's me for today, Lou. You know, my voice has stood up quite well. I'm pretty happy with that, and I think we've had a lot of interesting news to send out to our viewers today, who I hope have had a really happy Easter.
And we got through without a cough.
Yeah, that's right. So we've managed to shake off the lurgy, and we're back in town. So, but it's part of being human, isn't it? You got to grab the viruses as they come your way and just suffer.
Even when we don't want
it. Count down the days. Yes, so I guess we look forward to next week. Lou, next week will be interesting. We have the unemployment data out this Thursday, which will be very instructive. It'd be interesting to see how the Reserve Bank reacts. Well, we're also going to have the minutes from the Reserve Bank meeting out. We can talk about its latest meeting, but I think the unemployment numbers will be, very well anticipated because, will they show some easing in the labour market? The Reserve Bank has us on hold. It would be hoping to some degree, I think, that the unemployment rate did start to soften a little bit because that would justify its wait-and-see attitude at the moment. But if it's another strong result, Lou, I think that Reserve Bank's going to feel a little bit isolated here, and they may have to pop rates back up again when they meet again in May. But it's going to be very interesting to see those results coming up this Thursday, and we'll discuss that in some depth next week.
Fantastic. I look forward to it.
Yeah, me too, mate. Good on you.
All right. Thank you.
See you later, Lou.
Bye-bye.